The next stock I'm going to introduce is Palantir. In this review of Palantir Technologies, Inc., I will highlight the compelling reasons why Palantir is a strong buy, even after its massive rally of over 169%. From my calculations, if the analyst's estimate is fulfilled, the stock can rise as high as $49.60, showing a high level. With this in mind, I did a second round, revealing that although Palantir may be a bit more expensive, it still has the potential to generate annual returns of up to 18%. So, considering these factors, I have decided to give Palantir a strong buy. Palantir, a leading software development company, specializes in data analysis. This includes creating software designed to analyze large datasets, extracting useful information that can inform the decision-making process. There are even legends circulating about events such as the assassination of Osama bin Laden and the revelation of Bernie Madoff's Ponzi scheme. Data mining, as the name suggests, involves the processing of large amounts of structured and unstructured data with the aim of generating useful insights. This information in turn serves as a basis for making sound and strong decisions. The data analytics market is poised to witness significant growth, with an expected CAGR of 18.77% from 2023 to 2029. During this period, the market is expected to reach a significant value of $655.53 billion. This strong growth is fueling the growing need for data analytics in shaping decision-making processes across various industries. Over the past 6 years, Palantir has experienced significant growth, with a gross revenue growth of approximately 42.81%. At the same time, its net profit showed that it was not a big but nevertheless good growth in the way, around 12%. The company is on track to achieve a full year of GAAP profit. In conclusion, a comprehensive analysis of Palantir's financial performance and valuation reveals a company with significant growth over the past 6 years, boasting an impressive growth rate of 42.81%. The company's margins have increased significantly, reflecting operating profit, and its balance sheet is strong. With $3.2 billion in cash reserves and no long-term debt. Palantir's healthy cash flow of $465 million and free cash flow ratio of 21.9% reflect its strong financial management. Palantir's internal value was analyzed using 2 different valuation models. The first model, based on research estimates, suggests a potential increase of 154.5%, with a real value of $49.60 and a future price of $107.20 by 2028. Second, a conservative model linking Palantir's growth to the data analytics market shows a slight margin but still predicts a strong annual return of 18.6%. Although some doubt surrounds these prices, the average of the 2 correct values gives $34.20, representing a high probability of 75%. The bottom line is that I recommend a strong buy rating for Palantir, taking into account the slight 3.4% downside suggested by the second round, and the massive 18.6% annualized return, reflecting the perceived safety margin. The more complete, however, it is very important to know the risks that may be based on the fact that analysts may rely on non-GAAP metrics, which is a key factor for investors in Palantir. The next stock I'm going to introduce is Broadcom. In my opinion, Broadcom has been among the best semiconductor companies, and I am not surprised that the company had a softer fall than many of its peers. Best of all, the company's years of investment in advanced processing and networking capabilities have created a real AI kicker that allows the company to deliver impressive progress on a continuous basis. At the end, at other times such as Analog Devices and Texas Instruments have, it is difficult. At about 80% since my last update, Broadcom hasn't caught up with NVIDIA, but is still better than the broader semiconductor space, including the likes of Marvell. I can't make the simple, Broadcom is too cheap, argument like I used to, but I still believe there's enough quality here to make it worth holding on to. Recently, stocks saw some volatility following news that Alphabet is considering replacing Broadcom as the supplier of Tensor's processing unit in an effort to cut costs. With Google likely to be a 10% customer in FY24 and these TPUs driving most of the revenue from Broadcom's AI, it's understandable that the traffic is shaky. As there are repeated rumors that Apple will use a home solution to replace the wireless network with Broadcom, I think that these rumors are exaggerated. And it is unlikely that it will bear any fruit. Will Google consider moving its business to Marvell or MediaTek in an effort to save money? Perhaps. But I will be surprised if this is more than a kick to check the strength of other suppliers. But maybe I look at these leaks and rumors as an attempt to communicate through media, as I saw the news that Broadcom wants to raise the price around 30% for the next generation of TPU. Google and Broadcom's relationship with ASIC culture is mutually beneficial. And I think that Google will find it difficult to find similar services from other vendors. Specifically, I think that working around Broadcom's IP and SerDes runs hard, let alone other capabilities like MAC circuit design and special memory. Given the challenges of AI leadership, I don't think Google will settle for a real AI accelerator ASIC. I'm confident that the move to Broadcom will do that. This does not mean that there is no risk. First, having a second source supplier makes sense and Marvell has improved its custom ASIC capabilities. I also see the risk of losing some of the network business in Marvell, as I think that the companies can be a little more here. Broadcom's circuit correction will be different for several reasons. First, the company has a long history of being active and maintaining target channel inventory, and I don't see much risk from channel inventory correction. Second, Broadcom has almost no exposure to markets such as automotive and industrial and is not vulnerable to weak 5G budgets. Although smartphone demand is still not clear in 2024, Qorvo seems to be gaining a small share of the market, and OEMs are recouping some of their investment in high-end features, many of which the failure is already in the market segment strategy for the air sector. I would like to note that the company announced another long-term contract with Apple earlier this year, and that there are more opportunities to benefit from the growing penetration of Wi-Fi. To offset this risk, I see not only strong growth potential in the AI portfolio, but also in its customer relationships. Management is talking about the value of hyperscale ASICs again, and I think Meta could be a billion-dollar-plus customer for Broadcom in this space. I'm interested in the opportunities offered by Broadcom's enhanced optical portfolio, especially the fast optical technology that eliminates the need for pluggable optical modules, and the company's ever-changing leadership that supports the advancements in front is based on AI, so investing in AI makes it more important. Ethernet is the best switch. Broadcom did a little better than I expected this year in terms of revenue and a little better in terms of margins and operating margins. Due to the strength of the company's AI portfolio, especially through its strength in generative AI investments, my revenue estimates for the fiscal year 2024 and 2025 are now about 3 to 4% higher. And I have increased my work plan next to about 150 background items. And better mix and better operational efficiency. There are risks on the margin if the non-AI semiconductor business is successful. But the potential of companies with a hunger for high-end, fast and high performance should limit the risk. Long-term, I expect annual revenue growth in the neighborhood of 5%, with additional margins driving free cash flow growth of about 1% beyond that. In the short term, I expect margins to remain around 74%, while operating margins remain above 62%. I can't say that Broadcom appears to be undervalued based on cash flow loss, although EV income and EV/EBITDA based on margins still show 10 to 20% upside. However, due to the nature of the company, I am willing to accept a lower return than I would for a semiconductor stock, and I view Broadcom as a core stock. If the AI hype subsides a bit, it may not be good for the stock. But I would look at it as an opportunity to buy a stock in a company that has proven time and time again that it can mix well engineering, R&D leadership, sales and excellence in a very attractive business model.